Do you know where you can find the biggest concentration of wealthy people? The one place where the majority of the world's billionaires are? Is the stock market. Why? Well, because the stock market is made up of companies, and companies are what creates most of the value in our world. In order for you to understand what stocks are, I will tell you one of my favorite quotes of Warren Buffett. He says that you aren't investing in stocks, you are investing in businesses. Once I heard that, I took it to heart and started applying it both in my life and in my teachings. The problem for most people is that when they see something like the stock market, they see a big abstraction. They imagine charts on screens, fancy jargon, and start getting confused. So let's bring things down to earth. What is a stock? A stock is a company. What is a company? It is a business. Just like your local bakery or grocery or gym is a business. However, when a business grows, it starts needing more capital in order to survive and thrive. Enter the stock market. When these businesses start needing more capital, they might choose to go public. What does that mean? It means listing shares on a stock exchange where anyone can buy parts of the companies. Those shares are simply those parts. When they do that, it dramatically eases their access to money because they no longer have to go to meetings, negotiate terms, sign contracts, etc. You, I, or a pension fund from Norway can simply place an order for X numbers of shares or pieces of the company, and the company receives that capital to work with. If it makes a good use of the capital, there will be a positive return or profit for the investor. And this leads to the following positive effect for us investors. The biggest, most productive, profitable, and stable companies in the world are public. If you look at any leader in any sector, be it Amazon, Microsoft, Coca-Cola, Apple, Google, Chevron, you name it, they're all public, which means that they are available to us common investors. This is the revolutionary thing about the stock market. You can literally log into an app on your phone, press a button, and with $50 become an owner in the biggest, most powerful, and most productive businesses in the world. That's the power of the stock market. It's not about trading in and out of stocks. It's not about looking at abstract charts on a screen wondering what will go up and what will go down tomorrow. It's about owning a piece of the world economy, letting your money work for you instead of you only working for it, while the upside of your labor goes to the owners of these corporations. Now you can become part owner in them and reap the reward too. But in order to do that, you first need to understand how to buy shares in these businesses. Do you call them directly on the phone and ask them to buy parts of their company? Do you go to your local bank? How does that even work? This is what we will discuss next in our Investing for Beginners guide. So, by now you've already decided you want to buy some stocks. Let's say you want to buy Walmart. Do you go to Walmart, get some groceries, and at the end ask the cashier to give you a stock certificate for one share? Probably not. Or do you go to walmart.com, call the customer service number, and ask them if you could buy some shares of their company? Nope, that won't work either. So, how do you buy shares of the companies you want to invest in? Enter the word brokerage. A brokerage firm is basically a middleman who connects buyers and sellers to complete a transaction for stock shares. Now you might be thinking, oh, these middlemen always looking to make money from us. But there are two very important functions that brokerages have, without which, to be quite honest, the stock market would be quite broken. So let's go with our example. Imagine you actually find the right people in Walmart to sell you some shares. You go to their investor relations department and you manage to get someone on the phone. The first issue you face is that unless Walmart is issuing shares currently, they can't sell you any. And because of that, now they will have to call some of their previous buyers and ask them if they want to sell some shares so you can purchase them. But then you ask for a certain price, then Walmart's rep would have to go back and negotiate a deal, etc., etc. This quickly becomes quite the mess. So instead, what brokerages do is they use modern technology to automatically match buyers and sellers. Within a click of a button, you press buy, and a second afterwards, you have your shares. This would have been impossible without the brokerages as an intermediary. Second, no offense, but Walmart doesn't really want to deal with you. I mean, sure, if you're Warren Buffett and you're planning to invest $1 billion, you could probably call the management. But for you and me, they really wouldn't lift their finger and it would be a complete headache. So, step one in buying a stock is choosing a brokerage. The brokerage firms consolidate the investments of tens and even hundreds of thousands of investors and invest on their behalf. Of course, for that convenience, they charge you fees, but the modern brokerages have such low, in some cases almost non-existent fees because of technology and competition, that unless you're day trading, doing tons of transactions every day, it doesn't really matter that much. Now, The question comes, how do you choose a brokerage? If you try to Google it, you will find dozens and dozens of companies offering you their services. For the purpose of this guide, I will divide the brokerages into two categories. The traditional, older, larger brokerages is the first one. And the second one is what I call trendy apps brokerages. The trendy app brokerages are companies like Robinhood, eToro, and others. I'm honestly not a fan of them and have never used their services, and so I cannot speak from experience. But what I know is that most of these companies design their apps in a way that is really easy and intuitive to use. However, they also design it in a way that makes you trade more often. And trading often is the enemy of the long-term investor. If we compare that with the interface of an older, more established company like Interactive Brokers, it's pretty clunky. The navigation is a standard one, at least for the web version. However, I actually like it that way. After all, I'm not logging into my account to be entertained. Speaking of that, the older, more established brokerages are brokerages like Interactive Brokers, Fidelity, Charles Schwab, and others. These are the biggest, most established ones and the most heavily regulated. When it comes to choosing a brokerage, I like being old school. I like sticking to names like these because the security of my assets is too important to gamble with it. I want companies which are heavily regulated in multiple jurisdictions, including the USA and the EU, have been around for decades, and hold money for the wealthiest investors on the planet. If those conditions are fulfilled, I really don't care about how sleek their design is or if I will save 20 cents per transaction on fees. Remember, we are investors, not traders here. If you recall, I said that brokerages basically aggregate investors' funds and through economies of scale are able to offer us this great service of almost zero commission investing. However, this poses the question that is on every investor's mind. What happens to all my stocks if the brokerage which I invest with goes bust? After all, do I even own my shares if they are investing on my behalf? These are all questions you should be asking, and I want to put your mind to rest. The magic word here is segregation. Segregation of assets. What regulated brokerages do is they keep the assets and operations of their company separated from those of their clients. So basically, if John invests in Walmart stock, his shares are kept separately from the shares of Richard, who also invested in Walmart stock, and all of these assets are separated from the brokerage's financial operations. At least this is how regulated large brokerages operate, which makes it even more important for you to use such. In the event of a brokerage failing, basically what happens is your stocks are transferred to another competitor of them, and most likely with a little bit of turbulence and wait time, you have to log into another website. But your assets are still yours. Not only is the likelihood of a large regulated brokerage failing close to zero, but if it happens, it's not the end of the world. If you invest in Coca-Cola, you are still the owner of the shares in Coca-Cola, and which brokerage exactly manages your investments won't make that much of a difference. Also, your investments, and that includes the cash in your account, are insured up to certain limits depending on the country you're in. In the USA, it's up to $500,000, for example. And remember, you get your shares no matter what if you use a reputable brokerage. So this is just an extra precaution and a safety net for your cash in your account. All right, now that you know what stocks are and how to buy them, let's move to the juicy part. How to build your wealth and create the ultimate passive income machine that will last for generations using the stock market. One of the ways to profit from stocks is the buy low, sell high strategy. In case you don't know, this means buying something when the price is low and selling when the price is high. Stunning insights, Ognian. The strategy sounds simple, but it actually isn't. And now I will talk about how to do it, what it is good for, and what problems you will face by executing it. The buy low, sell high strategy relies on the price appreciation of a stock. If you buy company X for $100 and sell it for $200, you obviously made 100% profit. The tricky part is that because there is no cash flow involved, since you are not relying on dividends, there is a degree of speculation involved. You don't make any profit until you sell. You might be sitting on that stock for 5 years, and the only thing you will be seeing is your profit on a screen. But it's not real until you execute a sale. How do you know when to sell though? This is what we will discuss now. There are hundreds of ways investors use to determine when to sell a stock. Since I don't want to make this video 5 hours, I will briefly look at 4 of them. The first one is the PE ratio. PE stands for price to earnings. Earnings is basically the profit of the business. If a company earns $1 million per year and it is worth $20 million on the stock market, then it has a price to earning ratio of 20. 20 is the multiplier on the $1 million of earnings the market has put on a stock. The more stable and with better future prospects the stock is, the higher the multiplier, also known as multiple, will be. If the price goes to 25 million while the earnings stay at 1 million, then that means the market is valuing the company and its profits at a higher level. Pretty simple. Investors like to look at what's known as the average price to earnings ratio. They take, for example, the average of the past 10 years. If it is 15 and now the stock PE ratio is 25, then the common wisdom is that the stock is undervalued and you might want to sell it. However, I personally don't like to use this indicator because it is very flawed. It tells you nothing about the future prospects of a company. It might happen that the company has revolutionized their business and the big gains are just getting started. And the problem is, you would have sold early because you were looking at the average for the past 10 years, not factoring the big changes that are happening. Another way to see if something is undervalued is the market sentiment towards it. Since this is more of an internal psychological assessment, there isn't exactly a hard piece of data that you can use. It's just the market's positioning. Some people use call or put options, which are basically bets on whether the stock will go down or not, but that's far too complicated and is for traders, so I won't get into it here. A useful tool you can use for the market in general is the Fear and Greed Index, which you can find here, but this tool is used for the market as a whole, not individual sectors or stocks. With the next two ways, we are getting more into the realm of trading and technical analysis, so I will just mention them quickly. The first ones are various momentum indicators. Example of that are Relative Strength Index, known as RSI, and Williams Percent R. When you use them on a chart, both are showing you whether a certain stock is overbought or oversold. If the stock is overbought, that means that it is way above the normal and there is too much buying activity going on, which means that supposedly there should be a pullback of price and you might want to sell. On the contrary, if it is oversold, that means there are way too many sellers and the stock is out of balance, which means you might want to buy. I'm oversimplifying it and it's not as easy, but this is not a trading course. The last way I will mention are the support and resistance levels. When you are looking at a chart, sometimes you will see a lot of places where the price has bounced and gone back and then bounced and gone back. These are called support for the downside and resistance for the upside levels, and they indicate that there is a big battle between sellers and buyers there. Once the price breaks out, a lot of people use it as an indicator to either sell or buy, depending on the direction. Now, all of these methods are very problematic and to me are not suitable for the average investor. I think that the only really good way to use the buy low, sell high strategy is to have an overview and opinion of a company or a sector and understand the reasons why it might do well in the longer term. And by longer term, I mean years. For example, if you thought that social media would have been a big thing back in 2013, you would have done very well to purchase Facebook stock, which is now called Meta. Once you have that overview and conviction, you buy and you hold for two reasons. The first reason would be to build up your wealth and protect yourself from inflation for an indefinite future. Let's say you believe the technology sector will do great and you know you might want to start using your money for something 20 years down the road. You buy a fund full of tech stocks and you wait. 20 years have passed and now you want to start spending. Hopefully you are right and now your money has been multiplied. A second reason why I think someone should use that strategy is for tactical purposes of buying something. Let's say a house or a dream car or whatever. That way you have something to aim at. Let's say you have $50,000 and you want to pay your mortgage that is $100,000. You hope that in 4 years, those $50,000 would become $100,000. On the fourth year, hopefully you are right, the $50K have turned into $100K, you sell all of your investment and you pay off your mortgage. You had a goal, you knew when you reached that goal, and you fulfilled it. The reason why I don't think it's a good idea to hold stocks that don't pay dividends without any direct goal is that you essentially turn from an investor to a charity. I sometimes ask people, all right, so when are you planning to sell this company? They answer to me, never, it's a great company. I'm like, okay, does it pay a dividend? They tell me, no, it doesn't. And I'm thinking, wait a second. So you just gave your money to a corporation that doesn't pay you anything for owning it. And when I ask you, when will you take profits? You say never. Pardon me, but I think this is the definition of charity. You gave part of your wealth to an organization. That organization is working with the money and you will never make use of it. Having said that, it brings me to the problems with the buy low, sell high strategy. The first one is that it often turns into buy high and sell low. Very few people can accurately predict the market's movement consistently, and so if you try to do more short-term version of the strategy, by short-term I mean months, it will likely backfire. Statistics are simply not in your favor. That leads me to the next issue. As I said, no one really knows when the highs and the lows are, and so it's really hard to decide when to take your profits. How do I know? I have actually asked people. This is a poll I made in 2022 in a local investor Facebook group with tens of thousands of members. The question was, to sum up, if people who have non-dividend paying investments have sold them for a profit in late 2021 and the beginning of 2022. In the picture, you will see the word capital gains, which means the profit you make from selling something at a higher price than you bought it. So why exactly did I ask that question? The reason is that ever since the financial crisis of 2008, these types of assets described in the question were going up and up and up, and that was known as the longest uptrending or bull market in history. However, it ended in 2022 for reasons that are beyond the scope of this training. But what you need to know is that for the first time in over a decade, the prices of these assets fell with tens of percentages, in some cases even up to 90%. The idea is that if you couldn't take advantage and make substantial profits before prices crashed during more than a decade of the biggest increases in prices of assets in the history, well, then when the hell do you expect to be able to do that? The result was, as you can see from the poll, that out of 282 votes, 87% of people didn't do it. 87% following the strategy of let's just buy and hold and I will sell in the future couldn't take advantage of the best time in history to do that. Well, if they couldn't do it then, I would argue that they will never be able to do it because it's hard. Because you don't know if now is the right time. You don't know if it is a temporary crash and you don't want to feel like a fool for selling. It's hard to predict and it's really tough on you mentally. And to prove that to you, the same assets went up like crazy in 2023, just as everyone was expecting recession and new lows. Another issue is that you depend on the market's perception of a company, not only the company's real cash generation ability. We already discussed the PE ratio, where the market assigns a multiple on the profits of a stock and this creates the price. Well, if for some reason the profits of the company stay the same, but the market decides that it will value it at 10 multiple instead of a 20, the price drops in half. And this might be because of something a country leader said on the other side of the world that spooks people. At the same time, your stock might be selling the exact same amount of soap or shampoo or oil and making the exact same money, but your ability to profit from it has been cut in half. Also, even if your investment is going up, it's really hard to make a budget and live off of that investment. I mean, sure, it's gone up 12% yearly for the past 10 years. So how much can you spend next month? No idea. Maybe you start spending 12% per year, which is 1% per month. But what if for the next 5 years it goes up by 6% yearly? Now you have made a big mistake and have eaten into your original investment instead of the profit. It's really a huge roller coaster, especially if you want to achieve the dream of living from your investments. For that reason, I personally like using this strategy only for tactical goals, but not as my core general investment strategy. In my opinion, there is a far better one, and we will discuss it next. The best long-term investing strategy should not make you guess the price of the stock market tomorrow. It should also allow you to take a vacation and still receive money in your bank account. And it definitely should not give you sleepless nights. So, if you agree with me, let's explore this strategy. You see, if you have to sell the shares of your stocks every time you need to pay for a personal expense, this seems like a pretty nerve-wracking deal to me. Or imagine having 2 houses in one city that you receive rent for and an earthquake strikes or there is a riot there. Again, not ideal. What solves these problems? The strategy of dividend investing. Dividend investing is the act of investing in companies in the stock market that pay dividends to their owners. A dividend is a distribution of cash that lands directly into your account regularly. Most companies and funds pay them every 3 months, some pay them every month. The idea is that because the business is profitable, it is rewarding its owners, which include you, with a distribution of those profits. The dividends are announced and paid on a per share basis. So if you have 100 shares of a company that pays $2 per share, you will receive $200 in dividends. As you have probably noticed by now, when that happens, you don't need to sell any of your 100 shares in order to get cash. You are receiving it straight in your account, distributed by the company, and after you get it, you still have the initial 100 shares. This is one of the most appealing qualities of dividend investing as opposed to buy low, sell high strategy. You never have to lower your ownership in the company in order to make a profit. Before I continue with the reasons why this is my favorite strategy and why it is the best one for the average person, I have to be honest here. Nothing is perfect. So first, let's talk about the disadvantages of dividend investing. The first and the main one are taxes. Each time you receive a dividend, it is taxed. Now, at what rate or if it is taxed at all, it depends on where you live. However, the general idea is that since you're receiving the distribution, you owe taxes on it. Of course, you also owe taxes if you sell a company stock for a profit, because either way you are making money and getting it in your bank account. So if you want to use the fruit of your investments, you will probably have to pay taxes. The only way you don't pay taxes on your investment is if you have a stock that doesn't distribute dividends and at the same time you don't sell any shares from it. Another minor con of dividend investing that only applies to people who are not experienced in it is that sometimes you might fall for something known as an yield trap. The yield percentage is the percentage of the dividend compared to the price of the stock. If the price is $100 and it pays $5 in dividends, the dividend yield is 5%. An yield trap is a company that pays very high and attractive dividend yield but can't sustain it for long. Usually, they might be in a declining industry or have a lot of debt or something like that. Inexperienced investors that only look at the yield and not at anything else might fall for it, only to find themselves with the company eliminating the dividend because they can't sustain it any longer. There are ways that this can be easily avoided by just a few important metrics, but they are beyond the scope of this video and I teach people about them in my general content and in my investing program. Now, let's get to the advantages of dividend investing. The first one is that dividends are a lot more stable than share prices. The price of a stock fluctuates non-stop and depends on the psychology and mood of the market, the news, wars in the distant part of the world, what the finance minister said this morning, etc., etc. That's not the case with dividends. They are paid out of the company's profit. If the business sells more shampoo, you get more dividends. Period. Speaking of shampoo, here is a chart showing the price fluctuations of one of the biggest and most famous dividend pairs, Procter & Gamble. All the red squares point to a prolonged period of price decline. You can see the volatility. And I didn't even want to circle the small price fluctuations you also see on the chart. The price is constantly going up and down. And here is a chart of their dividends. This company has been paying increasing dividends for decades and decades. Throughout all the price fluctuations I showed you in the previous chart, they are depositing money in your bank account non-stop. Isn't that awesome? I mean, just compare the two charts and you can decide for yourself which one makes you sleep better. Another advantage of dividend investing is that the cash from your dividends can pay for your life, something you can't achieve if you are simply looking at a stock price increase on your screen. You get the money in your account and you decide whether you want to reinvest it to compound your wealth or pay your bills with it. Imagine how much more fulfilled you are going to be if you are constantly getting cash in your account, regardless of whether you spend it or reinvest it, instead of watching a line go up and down on a screen for years and years. The next advantage of the dividend strategy is that it is really a lot easier to pull off psychologically. A little side note here. You have to understand that investing isn't only a game of numbers and charts. It's also a mind game. If you can't sleep well at night with your style of investing, regardless of the fact that your body has great results with the same exact style, you will probably be screwed. You will make a mistake, you will panic sell, or at the very least, you will hate your life. When you invest for dividends, it's a lot easier to keep your emotions under control. If you have a stable company that pays you month after month, you won't be as obsessed with what's going on with the stock price. If it goes down, you are less likely to panic sell because you want to avoid further losses, even though the company has a sound business model and is just currently out of favor with the market. The opposite of that is the so-called FOMO, or fear of missing out. Imagine you buy company X. It doesn't pay any cash. You hold it for a year. It goes up 30%. You're now thinking, if I hold it just a little bit more, I might make 40%. Next thing you know, the stock crumbles. Or you have the reverse situation. You sell for profit, and right after you do, the stock shoots up another 30%. Now you feel like a fool. It's just an absolute roller coaster of negative emotions, which can be avoided with the strategy of dividend investing. Another psychological benefit is that dividend investing focuses your attention on the right things. When you invest only for price appreciation, you might get caught up in the latest trend or only focus on the stock price performance. However, dividend investors are much more interested in how the actual business is doing. As Warren Buffett famously said, you are not just buying stocks, you are becoming an owner in a business. When you need to assess how likely it is for a company to sustain or increase its dividends, you focus on metrics like free cash flow, payout ratio, interest payment coverage, and a lot of other metrics that I show my students and I also talk about in my content. You just become a better investor who is way more capable of evaluating a company's performance simply by shifting your goal and focus. An argument I often hear about is that if you own non-dividend paying stocks, you can simply sell shares and create passive income for yourself that way. While that is technically true, it's hard to pull off. When the price of a stock goes up, you have no idea whether it is going up exactly proportionally with their better business results or because of a little bit of hype. And so you might start selling shares, and after some time, because the price had gone ahead of the business fundamentals, it might start to stagnate. However, you've already been selling shares of the company and now you have less of them. And now you have less shares, they're not going up, you have no dividends, and you've got bills to pay. Not a fun place to be. With dividends, you let literally the best management teams in the world decide what part of the company's profit can be distributed to you without compromising the growth or stability of the business. And companies like Procter & Gamble or PepsiCo have been doing that successfully for literally many decades. So it obviously works. And not only is this strategy way better for your quality of life, but it is actually more profitable for you. A study done by Hartford Funds reveals that going back to 1960, 69% of the total return of the S&P 500 index can be attributed to reinvested dividends and the power of compounding. Also in the same study, it is shown that companies that grew or initiated a dividend have experienced the highest returns relative to other stocks since 1973, with significantly less volatility and drama for you as an investor. One of the main reasons for this is that companies that pay dividends are more disciplined in their money allocation because they have a commitment to the shareholders, which keeps them accountable. Also, a growing dividend signals that the business is doing well and is confident in its future. And the last benefit I will talk about is probably the most important and is what got me started investing with this strategy. There is something called dividend reinvesting, which means that when you get the dividend in your brokerage account, you can choose to buy more shares of the same or different company with it. That way, you will be using the company's money to buy more ownership in the same company or in another one. So your wealth can basically grow on autopilot without you adding more personal money in it. And if you decide to contribute monthly, the effect only gets stronger. It is also known as the compounding effect and is really miraculous once you see it. Here is an example with conservative numbers that are totally realistic. In the first case, the DRIP, which stands for dividend reinvestment, is off. If you invest $1,000 a month for 30 years, the final amount of your portfolio would be $751,000 and the yearly dividends you will be receiving will be $67,000. Don't get me wrong, that's pretty good, but let's see what happens when we implement the snowball compounding effect. We turn on the dividend reinvestment function and our dividends are buying us more shares, which gives us more dividends, etc. And here are the results. After 30 years, our portfolio will be worth $2,162,000 compared to the previous $751,000. And the dividend we will be receiving per year will be $180,000. The difference is staggering. And remember, this is done by investing $1,000 a month consistently, not by being a millionaire or winning the lottery. And the best part? Each month, you can decide whether you want to increase the compounding effect by reinvesting the dividends or get them in your bank account and spend them. The decision is yours. That gives you flexibility, for example, when you get fired, to not take the first job that is being offered because you have passive income coming to you every month. You can use it to wait for a few months for better opportunities, then find a job that you like and start compounding again. And then, once you have enough, you can stop working and enjoy the passive income from your dividends. The choice is all yours. So, as you can see, for all the reasons outlined in this video, I think that dividend investing is the best core investment strategy for the average investor who wants to build their wealth and create more freedom in their lives. Now, that doesn't mean that it is the only strategy or that you shouldn't use any of the others that we have talked about in this Investing for Beginners guide. I want to make sure you understand this because the internet is such a polarized black and white space that people rarely speak to you honestly and in a reasonable way. The reason is that by creating a division, polarity, and by attacking the other side of the argument, a creator taps into our tribal instincts and is able to gather more attention and make more money. This is an age-old marketing tactic that I know works, but I'm simply refusing to implement in the content I create. With that said, I want you to know that dividend investing is not the only thing a person should be using to build their portfolio, and the other strategies we talked about have their place. I personally use multiple of them. So don't get into this polarized worldview of either or and black and white thinking. It's just that for me, dividend companies and funds are the biggest part of my investing portfolio, and I also think that they should be the main focus of every investor that wants to achieve more freedom. Does that mean that you should not buy gold to protect yourself or buy non-dividend paying tech stocks for a few years so that you can make 100%? No, of course not. These are all legit strategies. But the end goal, the thing we are all striving towards, is a better quality of life and more choices and freedom for us and our loved ones. And I think dividend investing is the best way to achieve that. If you want more help with starting your journey towards investing for freedom, then check the links in the description for the ways I can be of help. In one of them, you will find my free investing masterclass, where I go much deeper into the dividend investing strategy. I compare it in great depth with other strategies, some of which we discussed in the current series, and I also show how anyone, regardless of their level of knowledge or prior education, can start building their wealth and invest for financial freedom. If you're interested in that or in other ways I can help you, check the description of the video.